What surprises people about me, they expect me to love gold. They think someone who's been investing for 7.5 decades, someone who values safety and preservation of capital, would naturally recommend gold as a core holding. I don't, not even close. And I'm about to tell you why. Because I believe millions of people are going to learn a very harsh truth about gold in the coming years. I want to warn you before that happens. Here's a universal truth about investing that governs everything. Productive assets always outperform unproductive assets over the long term. Always. Without exception. It's not complicated. It's mathematical certainty. Think of it like this. Imagine two farmers. One plants seeds in fertile soil. He waters them, tends them, harvests crops. Those crops feed people, generate income, and he uses that income to buy more land and plant more seeds. That's productivity, creating more productivity. The second farmer takes his seeds and puts them in a vault. He guards them carefully. He checks on them every day. They're safe. They're protected. But they never grow. They never produce crops. They never generate income. They just sit there looking shiny. Which farmer builds wealth? The answer is obvious when we're talking about seeds. But somehow, when we're talking about gold versus stocks, people get confused. Most people believe gold is safety. Gold is insurance. Gold is protection against disaster. And I understand why they believe that. It sounds logical. It feels safe. Humans have valued gold for thousands of years. But here's what I'm going to challenge directly. Gold is not safety. It's speculation. Gold is not insurance. It's a bet. Gold is not protection. It's a very expensive pet rock that produces nothing while you're holding it. I'm not promising you'll like what I'm about to tell you. If you own a lot of gold, this will be uncomfortable, but I'm promising you the truth. Backed by 75 years of data, experience, and observation, gold will disappoint you. Not might, will. And the people who prepare for that disappointment by investing in productive assets instead will build significantly more wealth over their lifetimes. Let me take it back to 1980. Gold had just hit an all-time high of approximately $850 per ounce. The world was in chaos. Inflation was running at double digits. Interest rates were through the roof. The Soviet Union had invaded Afghanistan. Iran was holding American hostages. Oil prices had quadrupled. Everyone was terrified. And when people are terrified, they buy gold. The experts were unanimous. Gold was going to keep rising. Some predicted $2,000 per ounce. Some said $5,000. The doom sellers said the entire financial system would collapse and only gold would have value. I watched smart investors, educated professionals, people with decades of experience pour money into gold. Not a little bit, massive amounts. Some were putting 50, 60, 70% of their portfolios into precious metals. And I followed a principle I'd learned 30 years earlier. If you don't understand something, don't invest in it. And if it doesn't produce anything, it's not an investment. It's speculation. Gold produces nothing. An ounce of gold in 1980 was an ounce of gold. It didn't generate earnings. It didn't pay dividends. It didn't create products or services. It just sat there looking pretty. So while everyone else was buying gold at $850, I was buying productive businesses, stocks that were deeply undervalued because everyone was panicking about inflation and geopolitical chaos. What happened over the next 20 years? Gold fell from $850 to approximately $300, a 65% collapse. For 2 decades, gold did nothing but lose value. Meanwhile, the S&P 500 went up roughly 10 times. Productive businesses, compounded earnings, paid dividends, bought back shares, and created enormous wealth for shareholders. This wasn't some obscure period. This was 20 years. An entire generation of investing. If you put $100,000 in gold in 1980, you lost 65% of your purchasing power. If you put $100,000 in stocks, you had over $1 million. Think about the opportunity cost. The people who thought they were being safe, conservative, and smart by buying gold actually destroyed their wealth. Not because they were stupid, because they fundamentally misunderstood what creates value over time. Here's the first harsh truth, and it's the foundation for everything else. Gold is fundamentally unproductive. I've called gold a pet rock before and got tremendous backlash. People were offended. They sent angry letters. They said I didn't understand monetary history or the role of precious metals, but the core claim stands. Gold just sits there. It looks pretty. That's it. It doesn't produce anything. It doesn't create value. It doesn't generate cash flow. Here's the mechanism. Wealth is created through productivity. You take inputs, labor, and capital, combine them, and create something more valuable than the sum of the parts. A business does this, a farm does this, real estate that generates rent does this. Gold does none of this. You buy an ounce today, you put it in a vault, 10 years from now, you have 1 ounce of gold. Nothing more, nothing less. Zero productivity, zero growth, zero compounding. Let me give you a concrete comparison. Say you have $2,000. You can buy an ounce of gold or buy shares in a productive business, let's say a company that makes consumer products. 10 years pass. What do you have? The gold is still 1 ounce. You can sell it for whatever the market price is that day. Could be higher than 2,000, could be lower, but the ounce itself hasn't changed or produced anything. The business, it's been making products for 10 years, selling them, generating profits, paying dividends, maybe buying back shares. The value you own has compounded through actual productive activity. Over the long run, productive assets beat non-productive ones. This isn't theory. It's observable reality going back centuries. The critics say I'm oversimplifying. They say gold has unique properties as a store of value. Fine. But storing value is not the same as creating value. And over decades, things that create value outperform things that merely store it. Here's the payoff for understanding this. Once you grasp that productivity drives long-term returns, you stop being tempted by shiny objects. You focus on businesses, real estate, things that actually produce the principal. Invest in assets that work for you, not assets you have to work for. Gold requires you to hope someone pays more later. Businesses work to create value, whether you're paying attention or not. Point number 2, people claim gold is insurance against inflation and currency collapse. I understand the logic. I've heard it 1,000 times, but they're missing something massive. Gold is not a good long-term inflation hedge. The data proves this conclusively. Here's the context distinction. In theory, during high inflation, hard assets like gold should maintain purchasing power while paper currency loses it. That sounds right, but theory and reality are different things. The mechanism, people believe. Government prints money, currency devalues, gold maintains real value. Simple, logical. The reality, gold is wildly volatile and doesn't consistently track inflation. Sometimes it goes up during inflation, sometimes it doesn't. Sometimes it goes up when there's no inflation. Sometimes it collapses despite ongoing inflation. Let me give you specific historical examples. We already covered 1980 to 2000. Gold fell 65% during a period that included plenty of inflation. That's not hedging. That's getting destroyed. Here's another example. From 2000 to 2011, gold went from around $300 per ounce to $1,900, a 6 times increase. This period included the tech bust and the financial crisis. Gold did well during crisis. Fine. That's what it's supposed to do, according to gold advocates. But then from 2011 to 2015, gold fell to around $1,150, almost a 40% decline. It lost nearly half its value in 4 years. During this same period, stocks recovered and rose strongly. So gold is insurance that sometimes works, sometimes doesn't, and has massive drawdowns that can last for years or decades. That's not insurance. That's volatility masquerading as safety. Without understanding this, people buy gold thinking they're protected. Then they watch it fall 30, 40, 50% and realize their insurance policy actually cost them a fortune. Here's my personal observation from 75 years of watching markets. Real inflation hedges are businesses with pricing power. Companies that can raise prices when their costs increase. Coca-Cola can raise prices. People keep buying Coke. That's an inflation hedge. Gold, it has no pricing power. It has no power at all. It's a commodity whose price depends entirely on supply, demand, and sentiment. The payoff. Stop thinking of gold as insurance. If you want inflation protection, buy businesses that can handle inflation. If you want stability, diversify across productive assets. But don't fool yourself into thinking gold protects you when the data shows it doesn't. Harsh truth number 3. Owning gold costs you money every year. This might seem small, but over decades, it's devastating. Gold has carrying costs, storage, security, insurance. If you own physical gold, you need a safe or a vault. That costs money. You might need insurance against theft, more money. Some people use bank safety deposit boxes, annual fees. If you own gold through an ETF or fund, there are management fees, typically 0.4 to 0.7% per year. Doesn't sound like much, but compound that over 30 years, and it's enormous. Here's the negative consequence. These costs come directly out of your returns. Every year, without exception, they're a permanent drag on performance. Compare that to stocks. Good businesses have no carrying costs for you as the shareholder. In fact, they might pay you dividends. Instead of costing you money to hold them, they put money in your pocket. Over decades, this difference compounds dramatically. Let me give you specific metrics. Say gold returns 3% annually before costs. After 0.5% in carrying costs, you're down to 2.5%. After inflation at 3%, you're losing purchasing power. A good business might return 10% annually. You pay nothing in carrying costs. You might receive 2% in dividends. Your real return is substantial. The spread between those outcomes over 30 years is the difference between struggling and thriving financially. Here's a personal example. Berkshire Hathaway owns businesses that generate cash. We don't pay to hold them. They pay us. Those cash flows get reinvested into more businesses or opportunities. That's positive compounding. If we held billions in gold, we'd be paying millions annually just to store it securely. That's negative compounding. It's working against you every single year. The principle, never underestimate the power of cost to erode wealth. Small percentages become large amounts when compounded over time. I remember visiting a billionaire's private vault once. This was years ago. He showed me his gold collection with tremendous pride, bars, coins, millions of dollars worth. I asked him a simple question. What has this gold done for you in the last decade? He thought about it. Well, it's gone up in value. how much I pressed, maybe 30% over 10 years. I did quick math. So roughly 2.7% annually. What did it cost you to store and insure it? He hadn't really thought about that, maybe 0.5% per year. So your net return is about 2.2% before taxes and inflation. You realize the S&P 500 returned approximately 12% annually over that same period. The look on his face told me he'd never done that calculation. He thought he was being smart and safe. In reality, he'd massively underperformed because he was paying to hold an unproductive asset while productive assets compounded without costing him anything. That's the hidden destruction of carrying costs. Harsh truth number 4, gold has no intrinsic value you can calculate. This makes it pure speculation. Here's the reframe. With businesses, you can do fundamental analysis. You look at earnings, cash flows, assets, growth rates. You can build a model and say, this business should be worth approximately X based on its ability to generate Y dollars in cash flow. You might be wrong. Your assumptions might be off. But there's a logical framework. There's something real to analyze. Gold has none of that. Gold has no earnings, no cash flow, no book value that means anything. Its value is purely whatever someone will pay for it. That's not investing. That's the greater fool theory. You're buying something hoping a greater fool will pay more later. That's speculation. That's gambling. Let me give you multiple examples of why this matters. Example 1, if a stock falls 50%, you can analyze whether the business is deteriorated or the market has overreacted. You can make an informed decision about whether to buy more, hold, or sell. If gold falls 50%, you have no framework. Is it cheap? Is it expensive? Nobody knows because there's no intrinsic value to reference. Example 2, when I buy a business at 10 times earnings, I know I'm getting 10% earnings yield. I can compare that to bonds, other stocks, alternative investments. I have a rational basis for decision making. When someone buys gold at $2,000 per ounce, what are they getting? A 10% yield? A 5% yield? Nothing. They're getting an ounce of metal and hoping sentiment shifts in their favor. Why does this difference matter? Because speculation without fundamental value is how people lose fortunes. They buy at peaks, driven by emotion. They sell at bottoms, driven by panic. They have no anchor to rational valuation. The clear criteria for investing, you should be able to explain why something is worth what you're paying. If your answer is because someone will pay more, you're speculating. The before and after contrast. Before understanding this, people think they're investing in gold. After understanding it, they realize they're gambling on sentiment and momentum. Big difference. Harsh truth number 5. Many gold promoters have massive conflicts of interest. Pay attention to who's telling you to buy gold and why they're saying it. This is crucial. Here's the absolute observation. The gold world is dominated by doom sellers, people who constantly predict hyperinflation, currency collapse, the end of the financial system, societal breakdown, and their solution is always the same. Buy more gold. Specifically, buy it from them. Some of these people genuinely believe what they're saying. They're true believers in catastrophe. Others are just selling gold coins, bars, or investment products and profiting from your fear. There's a major conflict of interest you must recognize. The destruction mechanism works like this. They publish scary articles. You get worried. You buy their gold products. They make money on markup and fees. The catastrophe doesn't happen. Gold doesn't soar. You're left holding an underperforming asset while they've already collected their fees. Here's a cautionary example. There are radio shows, websites, newsletters, all dedicated to gold. If you listen carefully, they're always predicting disaster. Always. The dollar's collapsing. The government is bankrupt. Hyperinflation is coming. War is imminent. Been hearing this for decades. Guess what? The disasters they predict either don't happen or aren't as severe as claimed. Meanwhile, businesses keep producing, the economy keeps growing, and people who invested in productivity got wealthy. The smart people who fell for this aren't stupid. They're scared. Fear clouds judgment. And gold sellers are experts at amplifying fear. Here's the protection rule. Be extremely skeptical of anyone who profits from selling you what they're recommending. If someone's business model is selling gold, of course they'll tell you to buy gold. That doesn't make them right. The payoff for recognizing this, you stop making fear-based decisions. You see the conflicts of interest. You ignore the doomed sellers and focus on rational analysis. The principle, when someone has a financial incentive to give you advice, scrutinize that advice 10 times harder. Harsh truth number 6, and this is mathematically devastating. Gold generates zero income, which means zero compounding. Mark this as a deeper point because it touches on the most powerful force in wealth building, compound interest. Here's the timeless principle. Compounding is the 8th wonder of the world. Those who understand it earn it, those who don't pay it, and compounding requires income or growth that reinvests into producing more income or growth. Rental properties produce rent. You reinvest that rent into more properties or improvements. Compounds. Bonds produce interest. You reinvest that interest into more bonds. Compounds. Stocks produce dividends. Companies retain earnings and reinvest them. Compounds. Businesses produce profits. Those profits buy equipment, hire people, expand operations. Compounds. Gold produces nothing. An ounce today is an ounce in 10 years. No growth, no income, no compounding, just an ounce. The extended metaphor. Imagine 2 farmers again. Farmer A plants corn, harvests it, sells some, uses the profits to buy more land, plants more corn next year, repeats. After 20 years, he owns 10 times the land and produces 10 times the corn. Farmer B puts his money into gold bars. After 20 years, he has the same gold bars. They haven't multiplied. They haven't produced anything. He's exactly where he started, except older. The human nature connection. We're wired to see shiny objects as valuable. Gold feels valuable because it's rare and beautiful. But feelings don't create wealth. Productivity creates wealth. Here's the multi-decade example. From 1980 to 2024, 44 years. Gold went from approximately $850 to around $2,000, roughly 2.4 times your money. Sounds okay until you calculate the annual return, about 2%. The S&P 500 over that same period went up approximately 120 times. Not 2 times, 120 times. The difference is compounding. Businesses reinvesting profits and growing. As Charlie Munger said, and I quote, "The big money is not in the buying or selling, but in the waiting." That's the authority quote to remember. But here's the critical addition. Waiting only works if what you're holding is compounding. If you wait with productive assets, time is your friend. If you wait with gold, you're just waiting. Time does nothing for you. The payoff. Invest in assets that generate income and growth. Let compounding do the heavy lifting. That's how wealth is actually built over lifetimes. Now let me acknowledge something important. There are extreme situations where gold can play a role. Hyperinflation, war, total economic collapse. In these rare catastrophic scenarios, gold might preserve value when everything else fails. I'm not denying that. Here's the context. In normal times, or even in typical recessions and market downturns, gold is speculation and underperforms productive assets. But in true societal breakdown, maybe gold helps. So here's my practical position. A small allocation to gold as disaster insurance could make sense. Maybe 5%, maybe. If it helps you sleep at night and you understand you're likely sacrificing returns for psychological comfort, but having 20% in gold, 50%, 100%, that's not insurance. That's fear and speculation masquerading as prudence. That's crazy. The step-by-step breakdown. Step 1, build wealth in productive assets, businesses, real estate, things that generate income. Step 2, if you're genuinely worried about catastrophic scenarios, allocate up to 5% to gold as insurance. Step 3, ignore the gold completely for decades. Don't check the price, don't trade it, just let it sit there doing nothing, which is what it does anyway. Step 4, focus 95% of your energy on the productive assets that actually build wealth. The implementation obstacle. Most people can't do this. They buy 5% in gold, then watch it closely, get excited when it rises, buy more, and suddenly they're overweighted in an unproductive asset. Here's my personal system. Berkshire owns no material amount of gold. 0. We've built wealth through productive businesses. If someone on our team suggested putting 20% of our assets in gold, I'd question their understanding of wealth creation. The payoff, you get psychological insurance if you need it without sacrificing meaningful wealth creation. I once knew an investor, very smart guy, who became convinced the financial system would collapse. This was around 2010. He sold most of his stocks, bought gold, lots of it, physical bars stored in multiple locations. He also built a bunker, stockpiled food, prepared for societal breakdown. He was absolutely certain disaster was imminent. The disaster never came. The financial system, while stressed, didn't collapse. Stocks recovered and went on to make new highs year after year. His gold, it went up for a year, then fell for 3 years, then went sideways. Over the next decade, it roughly doubled. The stocks he sold, they went up 5, 6, 7 times, depending on what he'd owned. I spoke with him recently. He's still holding the gold, still convinced collapse is coming, still waiting. He's been waiting for 14 years now, while productive assets compound without him. That's what happens when fear drives decisions instead of rational analysis. You prepare for a disaster that doesn't come while missing the wealth creation happening all around you. Point number 8, buying gold is fundamentally betting against human progress. Think about what you're really saying when you put significant wealth in gold. You're saying businesses will fail, innovation will stop, productivity will collapse, the financial system will break down, currency will become worthless, society will deteriorate. That's a profoundly pessimistic view, and historically it's been wrong, consistently wrong, for centuries. Here's the mechanism. Human beings are remarkably good at solving problems. We innovate, we adapt, we create value. Yes, there are setbacks, recessions, wars, crises, but the long-term trend is progress. Betting against that, progress has always been a losing bet, always. The people who got wealthy invested in progress, not in hiding from it. I've lived through World War II, the Cold War, multiple recessions, stagflation in the 70s, the dot-com bust, 9/11, the financial crisis, COVID. Every single time, people predicted permanent decline. Every single time, they were wrong. The economy recovered, innovation continued, businesses adapted and grew, investors who stayed invested in productive assets came out ahead. The critics of this view say I'm being naive. They say this time is different. They say debt levels are unsustainable, or technology will cause mass unemployment, or resource depletion will end growth. I've heard this time is different for 75 years. It's never been different in the ways that matter. Human ingenuity and productivity continue. There's the payoff for understanding this. You stop being paralyzed by fear. You recognize that betting on human progress and productivity is the rational long-term position. Betting against it by hoarding gold is emotional, not rational. The principal extraction, optimism about human capability, is not blind faith. It's pattern recognition based on centuries of evidence. Point number 9, many people are buying gold now because of legitimate concerns about debt, inflation, and currency debasement. I share some of those concerns. But gold isn't the solution. Here's what's actually true. Government debt levels are high. Central banks have printed massive amounts of money. Inflation has been higher than normal recently. These are real issues. But here's the reframe. The solution to these problems is not hiding in gold. It's owning businesses that can handle these environments. The correct approach: own businesses with pricing power. Companies that can raise prices when inflation rises, they pass costs to customers and maintain margins. That's real inflation protection. Own businesses with low debt and high cash flows. They don't depend on cheap financing. They generate their own capital. They survive and thrive regardless of monetary policy. Own businesses with strong competitive positions. They have moats that protect them from disruption. They compound value over decades. Gold is none of these things. Gold doesn't have pricing power. It doesn't generate cash flows. It doesn't have a competitive moat. It's just a metal whose price fluctuates based on sentiment. Multiple examples during the inflation of the 1970s. Coca-Cola raised prices. Consumers kept buying. Shareholders did fine. That's a real inflation hedge. During the financial crisis, Procter & Gamble kept selling toothpaste and detergent. Cash flows remained stable. Dividends were maintained. That's real stability. During COVID, technology companies adapted to remote work and accelerated digital transformation. Many grew faster. That's real resilience. Gold during these periods, volatile, unpredictable, sometimes up, sometimes down, no consistent relationship to the underlying concerns people have. Why does this difference matter? Because you want solutions that actually work, not solutions that feel good but don't perform. The clear criteria: if you're worried about inflation, buy businesses that can raise prices. If you're worried about debt, buy businesses with strong balance sheets. If you're worried about instability, diversify across productive assets. Don't respond to real concerns with a fake solution like gold. Point number 10, gold is currently near all-time highs. Buying now means paying peak prices. This is exactly backwards from how you build wealth. Here's the absolute observation. Most gold investors are their own worst enemy. They do everything wrong at the wrong time for the wrong reasons. The destruction mechanism: gold rises because fear is high. People see it rising. They get FOMO, fear of missing out. They buy at elevated prices. Then Fear subsides. Reality returns. Prices correct. They're left holding an overpriced asset. This is buying high and selling low, the opposite of what creates wealth. Let me give you specific numbers. Gold is trading around $2,000 to $2,100 per ounce as I'm speaking. That's near historical highs. The people buying now are paying prices that reflect peak fear and speculation. What usually happens after peak fear fades. Prices normalize. The people who bought at peaks realize they overpaid. Cautionary example, in 2011, gold hit $1,900 per ounce. Everyone said it was going to 3,000, 5,000, 10,000. People were buying with both hands. By 2015, it was at $1,150, a 40% decline. The people who bought at 1900 spent the next decade underwater, watching stocks compound while they waited to get back to break even. Smart people made this mistake. Educated investors, experienced professionals, because fear overrode logic. Here's the protection rule. You should buy things when they're cheap and unloved, not when they're expensive and popular. That's investing 101. But with gold, people do the opposite. They should be buying gold when nobody wants it, when prices are depressed, when fear is low. But they don't. They buy when everyone wants it, when prices are elevated, when fear is high. The outcome, disappointment, guaranteed disappointment. The payoff for avoiding this, you don't buy at tops. You don't chase performance. You don't let fear drive irrational decisions. The principle, price matters enormously. Even if you believe in an asset, buying it at the wrong price destroys returns. Let me give you a devastating opportunity cost example that shows what gold truly costs you. Imagine you had $10,000 in 1980. You put it in gold at $850 per ounce. Today, 44 years later, gold is around $2,000 per ounce. Your $10,000 is now approximately $23,000. Roughly 2% annual return over 44 years. Now, imagine you put that same $10,000 in the S&P 500 in 1980. Today, that's worth approximately $1.2 million. Let me repeat that. Gold, 23,000, stocks, 1.2 million. That's the difference between struggling in retirement and having a comfortable, life-changing nest egg. That's the difference between financial stress and financial security. And here's the kicker. You didn't have to do anything special. You didn't have to pick stocks. You didn't have to time markets. You just had to own a simple index fund of productive businesses and hold it. That if you listened to the gold bugs, if you bought into the fear, if you thought you were being safe and conservative, you sacrificed over $1 million in wealth. Harsh truth. Choosing gold over productive assets is choosing stagnation over growth. It feels safe, but massively hurts your long-term financial future. Now, gold advocates will say I'm cherry-picking dates. Fine. Pick almost any 40-year period. Stocks beat gold. Productivity beats speculation. This isn't one data point. It's the consistent pattern. Point number 12. Gold has worse tax treatment than stocks in many countries, including the United States. This is a practical disadvantage people often overlook. In the U.S., gold is taxed as a collectible when you sell it. The long-term capital gains rate on collectibles is approximately 28%. Compare that to stocks. Long-term capital gains on stocks are typically 15 to 20% for most investors. That's 8 to 13 percentage points of difference over a lifetime of investing. That tax difference compounds into huge amounts. You keep less of your gains with gold than with stocks, even if the pre-tax returns were identical. which they're not. But there's more. With stocks, you can defer capital gains indefinitely by not selling. You can hold positions for decades. You can even pass them to heirs with a step up in basis, effectively avoiding capital gains entirely. With gold, the same deferral is available, but remember, gold isn't generating any income while you hold it. So the deferral helps, but you're deferring nothing gained from an unproductive asset. Plus, if you sell stocks strategically, you can harvest losses to offset gains. Manage your tax bracket. Donate appreciated shares to charity for a double benefit. Gold offers fewer strategic tax planning opportunities. Specific metrics. Imagine 20% returns over 30 years. At 28% tax rate versus 15% tax rate, the difference in after-tax wealth is substantial. We're talking hundreds of thousands on a large initial investment. This is another hidden cost of gold that erodes long-term wealth. Point number 13, understand the typical gold cycle so you're not fooled by it. Here's the pattern that repeats over and over. Phase 1 gold is flat or falling. Nobody cares about it. It's boring, ignored. Phase 2, some crisis happens. Fear rises. Gold starts moving up. Phase 3, the rise accelerates. Media coverage increases. More people buy. Phase 4, peak euphoria. Gold is soaring. Everyone's talking about it. Predictions of much higher prices, more buying. Phase 5, fear flips to greed. Then back to fear. Selling starts. Phase 6, decline accelerates. Panic selling. Gold is dead. Phase 7, long stretch of dead money where nothing happens. Could be years, could be decades. During phase 7, while gold investors are waiting and hoping for the next spike, stocks are compounding, businesses are growing, wealth is being created everywhere except in gold. This cycle is repeated multiple times in my lifetime. 1980 peak, then 20-year decline. 2011 peak, then 4-year decline and years of stagnation. Now possibly another peak forming. Gold investors seem to forget phases 5, 6, and 7. They only remember phase 4, the euphoria. They convince themselves this time will be different. It never is. The mechanism, gold, is driven by emotion, not fundamentals. When emotion is extreme in one direction, it eventually reverses. That creates the cycle. The payoff for understanding this, you don't get caught up in the excitement. You recognize what phase you're in. You avoid buying during phase 4 when everyone is euphoric. In 2011, I watched the gold mania reach fever pitch. Everyone had an opinion on gold. Taxi drivers were talking about it. Dinner party conversations turned to precious metals. The certainty was absolute. The dollar is finished. The Fed is destroying the currency. Gold is going to 5,000, 10,000, 50,000 per ounce. I saw dentists, lawyers, doctors, smart, successful people in their own fields put huge percentages of their net worth into gold. 50%, 70%, some even went to 100% gold and gold mining stocks. They weren't investing, they were gambling. They'd been sucked into the euphoria, convinced this time was different, convinced the world was ending and only gold would save them. I tried explaining productivity versus speculation to a few. They looked at me like I was the crazy one. You don't understand the new paradigm, they said. The new paradigm lasted about 6 more months. Then gold peaked at $1,900 and began falling. It fell to $1,500, $1,300, $1,100. The euphoria turned to despair. The gold bugs kept saying buy the dip, but the dip kept dipping. Many people sold at the bottom, taking huge losses. Meanwhile, stocks recovered from the European debt crisis and went on to make new highs year after year. The people who stayed in productive assets did extraordinarily well. The gold investors, many still haven't recovered psychologically or financially. They're still bitter, still waiting for vindication that may never come. That's the danger of chasing sentiment-driven assets. Point number 14, people claim they own gold for diversification. Let me explain why that's questionable logic. The argument goes, gold has low correlation to stocks. When stocks fall, gold sometimes rises. Therefore, holding both reduces portfolio volatility. Sounds reasonable, but here's the reframe. Real diversification means owning different productive assets across various industries, geographies, and asset classes. Own stocks in technology, healthcare, consumer goods, energy, financials. Own bonds, own real estate, own businesses in different countries. That's diversification. Multiple productive assets that generate income and value in different economic environments. Gold doesn't fit this definition. It doesn't generate income. It doesn't create value. It doesn't produce anything. It just sits there with a price that fluctuates. Calling gold diversification is like calling cash diversification. Yes, it behaves differently than stocks, but it's not working to build wealth. It's just sitting there, often underperforming. The correct definition of diversification, owning a variety of assets that work to create value in complementary ways, not owning some productive assets and some unproductive ones. Multiple examples. Stocks and bonds are diversification. Both are productive. Stocks offer growth. Bonds offer income and stability. They work together. Real estate and stocks are diversification. Both produce income. Real estate through rents, stocks through dividends and earnings, different exposures. Gold and stocks. One produces value, one doesn't. That's not diversification. That's dilution. You're diluting your productive holdings with unproductive ones. Why does this distinction matter? Because true diversification improves your risk-adjusted returns. It reduces volatility while maintaining growth. Gold might reduce volatility slightly, but it also drastically reduces growth over long periods. The before and after contrast. Before understanding this, people think 10% gold makes them diversified. After understanding it, they realize 10% gold makes them 10% less productive. Point number 15, people criticize me as stubborn and old-fashioned about gold. Let me defend why this position is principle-based, not stubbornness. I've been consistent about certain investment principles for 75 years. Principle 1, invest in productive assets that generate cash flows. Principle 2, avoid speculation and focus on fundamental value. Principle 3, think long-term and let compounding work. Principle 4, ignore short-term noise and sentiment. Principle 5, buy things when they're cheap and unloved, not expensive and popular. Every single one of these principles argues against gold. Every one. Gold violates principle 1, it generates no cash flows. It violates principle 2, it's pure speculation based on sentiment. It performs poorly over the long term, violating principle 3. It's driven entirely by short-term noise and sentiment, violating principle 4. And people buy it when it's expensive and popular, violating principle 5. So am I stubborn, or am I just being consistent with principles that have worked extraordinarily well for 3/4 of a century? The mechanism, principles work when you follow them consistently, especially when it's uncomfortable. If I abandoned my principles every time an asset class got popular, I'd have no principles. I didn't buy technology stocks at absurd valuations in 2000. People called me stubborn. I was right. I didn't buy subprime mortgage securities yielding 7% in 2007. People called me overly conservative. I was right. I'm not buying gold at all-time highs with everyone predicting higher. People call me old-fashioned. I'm confident I'm right. The payoff, adhering to sound principles even when criticized, produces superior long-term results. Chasing whatever is popular produces mediocre results and frequent disasters. Let me give you one more powerful analogy to crystallize this entire argument. Imagine you have $100,000. You can do one of two things. Option A, buy a productive farm. The farm grows crops every year. You sell the crops, you make money. You reinvest some profits into better equipment or more land. Over decades, the farm produces more and more value. Option B, buy a pile of gold. You put it in a vault. Every year you visit the vault. The pile hasn't changed. It's still just a pile of gold. You can't eat it, you can't plant it, it produces nothing. You're just hoping that someday someone will pay you more for the pile than you paid. Which option builds wealth? The farm. Obviously, the farm is productive. It works for you. The gold pile does nothing. Yet somehow, when we talk about stocks versus gold, people forget this basic logic. Stocks are ownership in businesses, modern farms that produce value. Gold is just a pile of metal. The farm wins. Productivity wins. Always has. Always will. So let me bring this all together. I've been investing for 75 years. I've seen every kind of market condition. I've watched countless investment fads come and go. And I'm telling you, as clearly as I can, gold is not the answer. Gold will disappoint. You have a choice in how you build wealth. You can follow the doom sellers. You can buy into fear. You can put your money in an unproductive asset that's near all-time highs. You can hope that crisis drives the price higher. You can pay carrying costs every year. You can watch decades pass while your gold sits there doing nothing. That path leads to underperformance, regret, and missed opportunities. Or you can invest in productivity, in businesses that create value, in assets that generate cash flow, in companies with pricing power, low debt, and competitive advantages, in human ingenuity and progress. You can let compounding work for you over decades. That path leads to wealth. The negative consequences of the first path are severe. You will likely lose to inflation. You will drastically underperform productive assets. You will sacrifice millions of dollars in lifetime wealth. You will reach retirement with far less than you could have had. The positive benefits of the second path are transformative. You build real wealth. You participate in economic growth and human progress. You compound capital over decades. You create financial security and independence. You leave a legacy. Let me give you the rapid action recap. Stop buying gold near all-time highs. Stop listening to doom sellers with conflicts of interest. Stop confusing speculation with investing. Start focusing on productive businesses. Start thinking decades, not days. Start understanding that income and cash flow drive long-term returns. Start recognizing that betting on human progress beats betting on fear. Here's my credibility marker. I built wealth by following these exact principles, not by luck, not by leverage, not by trading, by owning wonderful businesses for decades and letting them compound. That's how wealth is really built. This is the torch passing moment. I'm giving you the truth based on 75 years of evidence. What you do with it determines your financial future. I predict with high confidence that gold will have a major correction within the next few years. People who paid $2,000 to $2,500 per ounce will watch it fall 30, 40, maybe 50%. They will realize that gold wasn't safe, it wasn't special, it wasn't insurance. It was just a volatile commodity driven by fear. And they'll wish they'd invested in businesses instead. They'll wish they'd listened. They'll wish they'd understood that productivity beats speculation. Don't be one of those people. Don't learn this lesson the hard way. When I think about the legacy I want to leave, it's not just about money. It's about principles. And one of those core principles is this: don't chase shiny speculative objects. Don't let fear drive your decisions. Invest in productivity. Invest in progress. Invest in businesses that create value. Gold has been a distraction, a sideshow. It's never been the path to real wealth. And it won't be in the future. The harsh truth: gold will disappoint soon, severely. Invest in productive assets instead. That's my warning. That's my advice. That's the reality. The choice is yours. Choose wisely.